Cześć, dzień dobry.
Hi, hello, Magda Kowaczewska, Investor Relations LPP, and Przemysław Ludkiewicz, Deputy CEO, CFO, member of the board, and Marcin Bójko, Controlling Director at LPP. We'd like to invite you to our Q1 results presentation. We'll sum up the first quarter and the beginning of the second one. We'll talk about the results from the first quarter and also share our plans for the nearest future. Traditionally, at the end, we will move on to the Q&A session. Now the floor goes to Przemek, and I will be back to you on events. Thank you very much. Good morning, ladies and gentlemen. Moving straight to the summary of the first quarter, I would like to tell you that we are very happy about the results that we've reached. Of course, the spring and summer collections that we offered to our clients at our stores were very well received. Owing to this, we had record sales figures and also record revenue in the first quarter. Our sales was 4.3 billion, which means an increase by 18%. But against current currencies, that would be an increase by nearly 26%. Why are we talking about constant currencies? When we go through the financial reports of H&M or Inditex, our greatest competitors, they also display their results in constant currencies. That is more natural for the companies that have a bigger exposure to the markets and currencies other than the domestic one, and this is our case now as well, because 55% of our sales are generated on markets different from the Polish one. That is why the fluctuations of the currencies also translate onto the revenue. In a moment, I'm going to tell you how we calculate the constant currency exchange rates, but if there were no fluctuations of currency exchange rates of the Czech koruna or euro to zloty, the dynamics of the sales would be at the level of over 25%. Our gross margin was by 2.5 percentage points better year on year. That is why we managed to have a record profit that grew by nearly 80%. That was 411 million. Also, net profit was 277 million. That is an increase by 148% year on year. We've opened 112 new stores in the first quarter, out of which 71 are dedicated to the Sinsay brand. So we are going to schedule that we announced to you when sharing the results for Q4. As far as corporate events are concerned, on the 30th of April, we paid dividend advance payment that amounted to 285 zlotys per share. Let me remind you that the total dividend this year will be 610 zlotys per share. So we are still waiting for October, where we'll pay the other tranche of the dividends of 325 zlotys per share. I would also like to signal the positive outlook for Q2. We are nearly halfway through the second quarter. So for the period from the 1st of May to the 10th of June, our revenues grew by around 90% year on year in constant currencies. In a moment, a very hot season will start for retail, particularly in our industry. I'm thinking about the sales that will kickstart together with the holiday period. So the end of June and July are marked with sales, and we can already see that this sales dynamics has increased its momentum. We're also hoping for a strong second half of this quarter. We're also expecting better sales margin year on year in the second quarter, and we sustain our plans concerning the expansion of our stores. We will open around 130 new stores. Constant currency. Why do we want to show it this way now? Well, as you know, There has been a quite significant strengthening of the Polish currency, of the Polish zloty. It is strong against the backdrop of the other currencies, and in the table what you can see are the most visible outcomes of this strengthening. Please pay attention to the fact that in the table where we wrote in Czechia that we reported in zloty 207 million zloty, a year ago it was 215 zloty. So as expressed in zloty, we are showing that our revenue in Czechia dropped by over 3%, but actually in the local currency, in the Czech koruna, we had an increase of sale by 12%. So quite a significant strengthening of zloty occurred, which resulted in the fact that when you take the reporting currency into account, the situation seems to be weak, but actually the revenues, sales revenues were very good there. Similar to Germany, again, in zloty, we reported almost 20% of increase in sales, but in Euro-German currency we had nearly 30% growth in sales, so far better than that. And again, that resulted from the strengthening of our currency. In Hungary, we reported in the report currency in zloty 12% of growth, but in forint that was nearly 26%. So you can see, generally speaking, that showing what it was like in constant currencies does matter, because opening the stores in many countries, you can see that floor space has increased by 19%, and the sales in constant currencies would display much higher numbers. So in total, you can see that we calculate backwards our revenue, which means that today's values of sales, 4,306 million zlotys, stay the same, but in order to compare what can be compared, we applied today's currencies and we expressed last year's revenue so as to have a point of reference. So in constant currency, what we had in the first quarter was an increase by 25.5% in revenue, but in zloty it is 18%. Let us move on now to the number of stores. You can see on the right-hand side a map showing the regions of Europe. Poland, of course, remains the key region with over 1,100 stores, with 18 new ones added last year. Another important region, second most important, is the SEE regions, so Eastern Europe, over 123 stores added, altogether over 530. Another region is Central and Eastern Europe without Poland, so Czechia, Slovakia and Hungary. Here we have over 320 stores with 58 added over the year. And we also have Eastern countries, that is Ukraine, Kazakhstan, Belarus and the countries of Middle East, where we have 225 stores, and again an increase by 38. Baltic states, 101 stores, and Western Europe, that is the UK, Germany, Finland and Italy, here an increase by 30 stores altogether. We have 60 stores in this area. So over the year we've added 337 new stores. We have nearly 2,400 stores in the entire chain, out of which of course the majority are those of Sinsay, over 1,040 stores, an increase over the year by 255 stores. The other brands also keep growing, but at a much lower pace, increase between 13 and 29 new stores in the brands Reserve, Crop House and Mojito. So we are developing according to our schedule, putting the greatest emphasis on the Sinsay brand. Let us move on to the financial results section, and here I will ask Marcin to take the floor and present the data. Thank you, Przemek. Good morning, ladies and gentlemen. In this part, we'll go to the main components of our report and the main operational and balance indicators. As for the revenue in the first quarter, we reached 4.3 billion in revenue, and an increase was very good in both channels. So both online and offline, there was a double-digit growth, which is something that is a source of great satisfaction, as it shows that the spring-summer collection was well received by the customers and female customers. We are very pleased about the result for online channel, where the increase of revenue was quite substantial, over 23%. We are particularly happy about this result when we look at the broader context of the market, that was actually flat, and in certain cases there were even drops out there. So the result of an increase by 23% is a very strong result against the market. In offline, nearly 22% growth. This dynamics we realized two ways. What mattered here was both the expansion of the chain network, or the network. We had 112 new store launches, but also we had positive dynamics as seen through like-for-likes, so in compared stores, those that have been with us for a longer time already. Looking at the online sales, both Poland and foreign markets grew by double digits. We've been developing our applications quite consistently. We've been improving the comfort and user experience, and looking at our shares in online, we can see that the changes meet customers' expectations. In online sales, ever since December, we've been also present in Bosnia. In the first quarter, the market in Bosnia offered us great sales results comparable to those in the Baltic states. So again, also here we had positive contribution, and the total activity in the online channel is something that we supported with somewhat higher expenditures on digital marketing. As for foreign revenues, the expansion of our network is something that we do in export markets, and you can see here the omnichannel sales, where the revenue from export markets constituted over 40% of the sales of the group. 1/3 was generated in the markets where we keep on developing dynamically, that is Central and Eastern Europe, as well as Southeastern Europe. The omnichannel sales grew double-digit in Poland, where the dynamics was 25%, and abroad, where it was 19%. And the countries with the greatest, highest revenues outside Poland were traditionally Romania and the Czech Republic, but there was also an interesting increase in Southeastern Europe, that is Greece, Bosnia, or Serbia. The floor space towards the end of the first quarter was 2.1 million square meters. Here we can see in the table that the regions of Central and Eastern Europe, as well as those of Southeastern Europe, already constituted relatively big share of our portfolio in terms of floor space, and over the first quarter they consistently grew, and the growth was over 21% in the case of Central and Eastern Europe, and in the case of Southeastern Europe that was over 28%. In total, we grew abroad by 26%, and the 11% growth in Poland is something that we achieved mostly through the development in retail parks in smaller towns. Maybe one thing to add here, in the first quarter, the positive trend that we observed and that makes us satisfied is that our revenue grew double-digit, be it following the report approach or when applying constant currencies. So the increases in revenue were far greater than the dynamics of the growth of floor space. Starting from the second half of last year, we've been implementing a very good approach, and we generate very healthy gross profit margin. We closed that period with 52.5%. There's been an increase by 2.5 percentage points, and that was mostly due to significantly lower nominal cost of collection purchase in dollar, the strengthening of zloty to dollar, and the smaller promotional actions year on year. So to put it directly, that was about the smaller scale of promotions. The first quarter was successful not only in terms of revenue and margin. What was under control was also costs. The cost of store per square meter in the first quarter decreased by 2.5%. It was 169 zloty, and looking at particular components, we can see that the rental costs dropped by 5%. It was mostly owing to the growing share of Sinsay, where the rental costs are the lowest, and also strengthening of zloty to dollar, because the majority of those contracts are expressed in this currency. As for personnel costs, HR costs, here we observed a minor growth of 2%, and the result was seen of our work performed in previous periods, that is automation and standardization of processes in the stores, and active adjustment of headcount to the maturing stores and growing sales. Owing to those factors, we were able to limit and mitigate obligatory growth of costs in this area. And the other group was the other costs, and here the main positive contributor was the normalization of the costs of energy, much lower in the previous period, so altogether that group dropped by 5%.
The cost effectiveness was indicated not only in terms of the stores, but within the entire group. The priority for this year was the growth of sales. We do not forget about the cost discipline, which is an important element within the entire organization. Therefore, the costs were growing much smaller than the costs. So this indicator amounted to 42%, and it was slightly slower than in the previous year. Combining those good results as for sales and cost discipline, we achieved a record high EBIT, operating profit, that was 411 million zloty, and this record high was achieved with a record net profit 9.5%. Summing up the P&L for the first quarter, in any aspect, so these three leverages, we had very good results. The sales grew with double digits, 51%. With the cost, we increased the operating profit with 411 zloty, and the net profit was twice as high as in the previous year. It was 277 million. As for the EBIT, 795, and with that the EBIT was a very good indicator for the scale of generating cash. Very good operating profit, 411 million. This could be directed to dividends and the organic development of our organization, but we will go back to it in a moment. As for the inventory, this is another indicator that is on a very good level. The first quarter, that was 3.5 billion zloty, so that was a drop by 4% year-on-year. As per the units, so per square meter, this also dropped by nearly 20%, and this level, 1,542 zloty per square meter, this is the optimal level, and this is the level that we are going to maintain, we plan to maintain in the next quarters. With a stable level of inventories and high dynamics. As for the sales, we improved turnover. As for the inventory, this amounted to 136 days. This is also the level that we perceive as a very good one. We want to maintain that level. Lower inventories, this is more favorable working capital with extended payment periods. As for any liabilities, this translated into a very good result, minus 333 million in the first quarter. This minus in terms of the working capital is very positive, and when we look at it year over year, we have 500,000 freed from the capital. As for the debt level, net debt level, that was 4.4 billion zloty. That was a 6% increase year over year. But with our scale, with opening new stores, this is a very natural level. The main factor here contributing to the net debt resulted from the leasing liabilities. In the next quarters, this is going to be the standard situation. As for the net debt compared to EBITDA, that was over 1.1. So we maintain this level in December. The bonds 0.3 billion. And the investments, the capex, we spent 286 million zloty, 80% of that, 233 for the development of our stores. The other part, 54 million, went and is going to be spent on the logistics so that we can support effectively our growing sales. Thank you, and now I pass the floor to Magda. Thank you. Every time, now and then, we invite influencers, people from the fashion industry. Now, Mohito invited for the new collection Sandra Kubicka, a model and an influencer. The main theme of this cooperation were feminine dresses, prints, white leg pants, high waist and tops. Sandra Kubicka was the co-author of this collection and promoted this collection. We know that it was a hit in sales. We invited a model and an influencer to cooperate with Mohito brand, aimed to raise the attractiveness and build brand recognition. This is crucial for us and for Mohito brand because of the development in the new markets. I will pass the floor to Przemek. He's going to talk about the logistics and AI, and I will come back with talking about ESG. Thank you very much. We are developing very fast. You know that apart from many stores, we need to catch up with our logistics. Therefore, we started enlarging our distribution center in Brześć Kujawski. You remember that 2 years ago we have opened the logistics center, and now we need more space to catch up with the stores that are opening really very fast. We plan in the first quarter of next year to open this new part of distribution center in Brześć Kujawski. Of course, this is the center built on our plot of land. This is our capex. And I want to say that such centers are built with the use of the state-of-the-art technologies, environmentally friendly technologies. So this is what we are using with opening this center with 160,000 square meters. And some of the information about AI. A lot is going on and a lot is talked about in terms of AI. We are also using AI in various projects in our company. I would like to say that we have established a team dedicated to AI solutions and the development of this technology. I will give you some of the examples that are already existing as for the use of AI in our business. This is related to e-commerce, of course. The very simplest activities related to AI refers to our contact center. This chatbot that we are having can very quickly respond to clients' inquiries in various languages. Therefore, we can save the work of about 150 people. And of course, this chatbot can operate in 27 languages. Another aspect where AI is working very well, these are photographs of our products. So instead of big photographic studios with a very tedious work with photographers and models, we have a very convenient solution with AI. We have a photograph of a model, then separately a photograph of our product or any pattern, perhaps of a dress or shirt or pants, and AI can very nicely compose this part of apparel on the model. And then we have also a background at our wish, so we can compose such a photograph, so we don't need to go somewhere in very exotic areas. So we are saving cost. AI is just suggesting the background. We can choose it, whether this is Paris or maybe some exotic island. This is all available at hand, so a significant savings here. And the time, a very quick time as for adding new photos. Then traditional stores, through machine learning, AI can add how to provide stock for a particular store, how many pieces, what kind of sizes should be there, taking into account the history and prediction, so we can provide better stock for the stores. AI is helping us. Therefore, we are not sending products that may not sell well in a particular location. So this is an added value to our management. We have also other solutions. As for AI, in terms of e-commerce, we are generating marketing descriptions for our products. The material, the appearance, everything is done through AI. We have also a recommendation system as for the category and client. So we can suggest a client what to add to the basket, apart from the things that were already chosen. And in terms of the stores, how to add stock into particular stores, what was sold, in what time, particular models. So we can work with replenishment much better in our stores. And logistics, e-commerce, the optimization paths as for packaging our products. Here we also use AI solutions. And predictions as for the stocking of our distribution centers. Here, logistics can also use AI-based solutions. The prices, especially in terms of price promotions, or when we enter the sales season, AI can suggest the pace, what kind of products should be discounted, or what kind of level of discounts should be applied to maximize our gross margin. We can also use AI. We are doing it in our product departments. AI helps us manufacture our apparel prints. So the scope of using AI is much larger. So we are learning how to use these solutions, and in the next quarters we will be able to use AI solutions. And now we go back to Magda.
Two pieces of information related to ESG. One is that in the last quarter, we decided to extend our cooperation with a Polish startup. It's called Use Waste. 2 years ago, we concluded a contract with this company that was related to working on the technologies of apparel recycling. We wanted to develop a method of regaining polyester fibers and then reuse them to produce new pieces of apparel, but with uncompromised quality. Now, we need to say that this has come to a successful fruition. Now, this is already possible. The majority of textiles are mixtures, say 90% of cotton, 10% of polyester. It is much more difficult to recycle such mixtures, so we decided to go a step further to extend the cooperation with the startup and start working on the recycling of the mixed textiles. So the goal of the cooperation now is to develop a technology that will make it possible to detach the polyester fibers from those mixtures and then follow up with implementing the resource rather than waste philosophy. Another thing related to ESG, when we calculated our carbon footprint, it turned out that repairing and upcycling would be necessary, as actually the used clothes are responsible for 10% of our footprint. We decided to reduce it, and we want to work on raising awareness of our customers on how to use our apparel. That is why we came up with a state-of-the-art campaign, Wear Your Story. This is the second edition already, because the previous one, Care for Your Apparel, was the first edition, and it was focusing on how to handle apparel. It focused on education on how to wash, dry, or iron the clothes. But the second edition of the campaign, Wear Your Story, is actually a campaign that focuses on fixing and upcycling the apparel pieces. And the goal of the campaign is to make it clear to our customers that when they prolong the life cycle of garments, when they repair them or upcycle them, that they can wear them longer, which is beneficial for the environment, and it also, of course, reduces the carbon footprint. Let me just mention that the campaign is accompanied by extensive communication with Reserved and Sensei via the following activities. In their mobile applications, there are banners that refer the customer straight to the campaign. This is for customers that use the application. Those that use the networks, the connection online, what we have for them on online solutions, but for our regular customers in offline stores, we have special leaflets, elements of the campaign there. Now, I will tell you about our plans. Ladies and gentlemen, as mentioned at the beginning, there is a very positive outlook for 2Q. We can see strong two-digit growth in constant currencies. Those by 19% ahead of us. As mentioned, we have a very strong sales-related end of Q2, so we are certainly hoping for the good revenue and sales revenue dynamics in that period, and also what follows, of course, is the financial results. Should have costs under control, good profit margin, positive response to the summer collections now is all that contributes to this hopeful approach. We have higher class products, premium ones like those pieces of apparel containing linen. These are very good. This is a very good offer for the summer. To our plan, 130 new stores should be launched in the second quarter. We're also summing up the overall goals, so 700 stores opened this year, out of which over 600 of Sensei brand. We are going to develop in small locations, but not just in Poland. We can see scope for further development in the entire Central and Eastern Europe, as well in South and Eastern Europe. We can see a similar development model for retail there. So the Baltic states, Poland, Czechia, Romania, Bulgaria, former Yugoslavia, all their retail parks are being created in smaller locations, and we would like to partake in this trend. entering smaller towns. In the years to come, we again stick to our goal of around 20% growth of floor space year on year. We also stick to our all-year guidance. Our goal is 21 billion of group revenues, gross margin on sales between 52 and 53%. We would like to maintain our discipline, and we should be able to stick to below 40% in terms of SG&A revenues. The offline revenues should reflect the higher floor space, so by the end of the year the floor space should grow bigger by 25%, and of course we count on positive like-for-likes. In the online channel, the first quarter already shows a double-digit growth year on year, and again this appears to be attainable as a goal. We'll invest 1.5 billion zlotys. That's the total capex, out of which 1.2 billion will be earmarked for stores. We also sustain our financial security. We are not planning, as Marcin has said, bond rollover. We would like to pay the bonds back, and the cash flow generated by the company is sufficient in order to pay out the dividend and to invest in the development of the company, new stores or new logistics centers. So no bond rollover plans. Thank you very much for your attention. This is the last slide in this presentation, and we invite your questions. Marcin and me are going to give you answers. Okay, so the first question. Is the company planning to buy its own shares? No, we do not have such plans at the moment. Is banking financing threatened? It's about the accusations of running business activity in Russia and also about withdrawing from credit agreements. We've talked to multiple banks. We've had a number of good meetings. The banks are still eager to finance us. We've been increasing the scale of this financial support. No credit agreement was terminated, so we can see no threat. Everything is all right. A question about tax rate. What does such a high tax rate stem from? Over 27% last year, this rate did not exceed 23%. Are you expecting this rate to persist throughout the entire year 2024? Yes, of course, here we will have to look into the details. What I can tell you now already is in the first quarter there was a one-off event, so an event that has happened as a unique one. Periodically, we upgrade transfer price benchmarks, and part of this update affected logistic companies. Some of the results were shifted from the fourth quarter onto the first one. So I think that is a single-time event that simply contributed to increasing this element of our results in this quarter. The sales of like-for-like since is growing in a solid double-digit pace. At the same time, there is a challenge, that is the compare of Omnichannel revenues in Reserved. In Poland itself, it was lower year on year. What is your diagnosis of this worst performance of Reserved, and what ideas do you have for the return of the increase in like-for-like this brand? Reserved and all our brands are profitable. Let me make it clear, so there is no threat whatsoever. Of course, Sinsay is the most quickly developing brand, but the other ones have varying pace. Now, Reserved or Mohito have already saturated the markets. We do not have a lot of scope for further increase for the development of the stores. We are focusing on developing online as far as Reserved is concerned, but also we want to grow outside of Poland. So looking at Reserved, everything is okay. The prices were somewhat higher year on year, and that might have impacted the sales figures. But it turned out that the German market actually sold the best in the first quarter. I'm talking about Reserved collections. So we have no worries as for the future of our brands. Of course, there are ups and downs. We are working on increasing the pace of the sales in Reserved, obviously, as well. Now, on like-for-likes, what kind of like-for-like can you see across the group in the second quarter so far? So far, it is a total like of a few percent, a strong few percent in plus. Question on AI. What impact will artificial intelligence have on reducing the operational costs of the company? Well, it's hard to say today. We can see, as also mentioned in one of the slides, that the first changes, so employing AI or deploying AI in our company, meant there were savings of 30 million zlotys a year, and that will surely be a greater level of saving. And we are talking here about savings in logistics, about a smaller portion of sales or lowering of the prices. We expect that long term these will be hundreds of millions zlotys in the future. It is hard for us today to evaluate this impact very precisely. We should bear in mind that this technology keeps on developing and will spread across various areas of our company. But these first attempts, the number of the projects that we have been working on, the newly established team is working on that, is high enough for us to be ready to invest more in this technology. The question on the cost. Why the SG&A share in the revenue in the first quarter is clearly higher than in the other quarters. So why is there this seasonal effect of the costs? Well, most of the costs in our business is fixed, so we have this leverage here. We can sell more from our stores without really bearing new costs. So basically, the higher the sales, the better for us, and this operational lever works. And there is this seasonal nature. The first quarter, February, March, April, you'll have lower sales in the entire year, and then the costs will be comparable. That's just a natural, normal trend that the first quarter has the highest index of cost to sales. Further quarters will reduce it greatly. So I'm sure that this target, so reducing this rate to below 40% for the entire year, will be attained. A question about margin, but margin in Q2. In the outlook for the second quarter, you wrote that you're expecting significantly higher margins. Does it mean that the gross margin will be similar to that you reached in the third quarter, so 55.8%? Talking about the third quarter of 23. Probably not that much, but that would have been great. Of course, that would be great. The third quarter is always the strongest. Just look at the months that we have there: August, September, November, October. There you have the sales of goods at full prices. It is only August that is marked by a certain proportion of sales. So the third quarter, also this year, is likely to be the strongest. But the second one, so May, June, and July. Again, July is marked with sales quite considerably, but I hope that this margin will be similar or even perhaps better than the one that we reached in the first quarter. Another question concerns the issue of regaining financial means from the Russian market. How is that going? We are following our plan as we showed you in the last presentation. When we summarized the year, there is an entire schedule of actually getting those receivables. These are for the goods and for the company. The ones for the company are going to be paid back towards the end of the year. We can see no threat in this respect, but of course servicing this for the goods, right, it is something that is done according to schedule. It should speed up in another quarter. So yes, we are getting the money back and the positive trend is clearly visible. What is the payback from new stores? The period of return on an investment concerning the new stores, and I'm talking mostly about the Sinsay ones, in the average approach shows us that this return period is around 18 months, so a year and a half. As you might know, for every new store, we are building an individual business case, and no store will go through the sieve that would have a longer payback period than 24 months. So a period of 2 years is a maximum one, but in real terms, it's shorter periods. The question about disruptions in maritime logistics: what are the effective freight costs? The turbulences in seaborne transport are still there, so the ships still do not pass the Suez Canal, but around Africa. That means 14 extra days of the voyage. We mitigate it by building it in our logistic and production calendars, so the longer delivery periods. So we have it under control, but slowly the prices of freight are rising. For us, luckily, we still have those prices of freight negotiated that we negotiated at the beginning of the year. The scale of our business, the number of containers that we contract, that we transport, which means that we can really safeguard the prices long in advance. Let me just mention that the prices today are much lower than those that you can see in the market, in the spot market. So maybe by putting it differently, we cannot see the negative impact of the costs on our margin. How about the prices of purchasing goods in dollars? Is there a pressure for an increase?
We can see that we managed, thanks to the merchants and the traders, especially since they manage these margins, so they are significant. In dollar exchange rate, we have 11% lower value, which is helping. We don't feel this pressure as for today, so we are maintaining the purchase prices as they are today, thanks to the effectiveness of scale in our case. This means that we are not planning the increase in prices in any of our brands. Now a comment as for the development of the floor space. There was a dynamic plus 26% year on year in 25. Right now, plus 20%. Why such a change in terms of the floor space? I believe that we are supporting the assumptions as we informed that at the very beginning. So 20-25% increase, as our CEO said, if the EBIT is at a good level, the difference is not that significant. But referring to the first quarter, with 19% growth, in the following quarters, the rate is going to speed up. So we will prove that we follow our plans. Do you support the end of sales to traders till the end of the year, or in the first quarter we have zero margin from sales? Yes, we support that. In 24, we will complete sales to trade agents. In the first quarter, we sold less than we planned. So everything is according to the plan. Following the plan, we can squeeze it up a little bit and complete it a bit earlier. In the first quarter, we increased your revenue in e-commerce with the same SG&A cost. In the following quarters, can we expect this trend to maintain, or are we going to have more expenses for the marketing? I will refer to the previous question, whether zero margin, this is the zero margin for the trade agents. Yes, that is correct information. And now a question about the e-commerce. Yes, depending on the market we are operating on, because these markets are different, we have different approaches. We try with our marketing budgets to use the most effectively. Of course, we buy clicks from Google or Facebook, but we also have more effective solutions, investing in our relations with bloggers or influencers. This is what we are using. So the plan is as follows. We want to increase marketing expenses by 15-20%. 6% to increase the sales. So we want to acquire new clients, but these are not going to be significant increases as in the previous year. So we are adjusting the budget to the real possibilities and the real needs on these markets, and we've been observing which markets sell best, where the dynamic is highest to be there. And if we observe a situation where marketing solutions are not working on a particular metric, then we are not planning to follow that. In geographical segments, there is a deterioration outside Poland and outside CE, the profitability, the operating profitability, and there is a loss in the West. So how that is related to the operating costs for immature stores, and maybe other factors you have noticed. Yes, you can see in our financial report these two regions with lower performance. I will start with Western Europe. Here, this loss refers to opening new stores in London and in Milan, in Italy. This is the biggest impact. So in the longer run, I believe these opening costs will disappear, these one-off costs, and the sales will improve because the brand will be better recognized. So the situation is going to be better with more mature stores. As for CEE, Czech Republic, Slovakia and Hungary, excluding Poland, here the results were worse because of lower performance in the Czech Republic. So we observed a slowdown in terms of the sales. On the other hand, we can see weaker koruna compared to zloty. So that's why we refer to constant currencies, to pay attention to the fact that some countries, in terms of performance in zloty, may perform worse because of the weakening of their currencies. So that was the case for CE. Now a question related to our brands, whether the Sensei format is just eating up the Reserve brand. Not really in general. You know that Sensei stores are opened in smaller cities where Reserved is non-existent over there. Reserved stores are in bigger cities and in more well-known shopping centers. I would like to say that there are certain tendencies. Clients are more willing to choose less expensive products. In Reserved, the pressure, let's say, we could say, or the biggest interest refers to low price products, but when there is a discount, more buy these products. Sensei is selling well in both distribution channels, so value for money is affected not only in Poland but the entire region by the clients who are price sensitive, so they look at the price of our products. A question on EBIT margin. Within a couple of years, can we reach 13%? With the development of Sensei brand. Yes, looking through the development of Sensei, yes, we will have certain dilution in terms of the margin. This brand refers to lower costs, so as for the operating costs, ESR, so that will be more profitable. As for the EBITDA, 12-13%, this is doable. A comment to the drop by 4% as for the exchange rate. So as for the cost of our shares, so we do not comment on that. A question as for likes. What were the likes in the first quarter? As for our biggest brands, Sensei, around 20%. House was similar. Reserved, 0 minus, if I could say that. Mojito and crop, 1-digit values. I believe these are all questions. Thank you very much for all these questions. Thank you for participation in our conference. And we already invite you for our next conference for the second quarter. This will be held in September. Thank you very much, and we wish you a very good summer holidays. Thank you.